Welcome to the session. And today I'd like to first talk about the access to new Blackboard site that was emailed, the information that was emailed to everyone on Sunday this week. So you've all been emailed your login details along with step-by-step guide on how to access the new learning management system, which should look like this at the time of when you will log in. So please make sure to log into Blackboard site through this system because the older version of it will be discontinued by the provider on 31st of December. Now, if you do need to save something from the past version, feel free to do so. But having said that, most of the information except for the discussion board conversations from the past version have not been copied, but rest everything else has been copied. The only other thing is the assessment documents that you have emailed from the past, not emailed, sorry, uploaded. The past assessment submissions that were uploaded in the older version along with my feedback is not available in the new version. So you can download that if you need to from the older version. But most of it is available now in the new version. If any issues with access, then please do not hesitate to let me know. Now, let me just do a quick screen share to show you what, where, and how that works. Just a minute, won't be long. I'll do a desktop sharing. Okay. So you should be able to see my desktop now. And this is where you have the information about the link for logging into your Blackboard site. So you have your username and password already emailed to you. And when you will log in, this is should appear an institution page. And when you go down on this institution page, you will see some video tutorials for you. Here's a link if you need to download this on your mobile. And this actually provides pretty good features. So feel free to use it through your mobile if you need. And plus some more tutorials just in case you are interested, but not necessary. Now, this is the page you need to go into, tab on the left-hand side called Courses. So you go into Courses and you should have access to this, the course, Diploma of Accounting that you are enrolled into. If you click on that link, it will take you to your diploma information. So now if you look at this, everything on the left-hand side is very similar to what you had access in the prior Blackboard site. So just it's a little bit more modern looking and yeah, pretty much the same. So feel free to access it and your links to the tutorials, recorded sessions, everything is there. And I've checked unit documents from the past also exist. So should be okay. I'll just stop sharing and go back to our whiteboard. Okay. So Ayami, did you access the Blackboard site? Or were you able to access the Blackboard site? Did it work okay for you? Hopefully it did work okay. Okay, perfect. Thanks for confirming. So Ayami has confirmed in the chat area that is working okay. Now look, if any problem, you're watching the recording and you see this and you find that you have access problems or issues, then don't hesitate to get in touch. So let's move on then, what we have to cover this week. We're starting with our new unit. New unit, look at that. Oh, one letter is already missing in that. When I was typing, I did a mistake. So it should be FNSACC516, not 16516. That's the unit code. And it's called Implement and Maintain Internal Control Procedures. Today, I will introduce the unit and talk about the first topic, which is Internal Controls 1. Overall, there are 3 topics in the unit: Internal Control 1, Internal Control 2, along with accounts receivable, payables, and cash, and topic 3 about audit and governance of accounting information systems. All 3 topics available through Blackboard site. That is, if you go under the unit documents in Blackboard site, you will find the learner guide and readings available in downloadable PDF format. Assessment document that contains 9 written questions and 4 case studies, and assessment submission links all ready for you within the Blackboard site. Now here's the correct code of the unit, FNSACC516, implement and maintain internal control procedures. Assessment submission date is 4th of February 2019. You might be thinking that's a bit too long, but well, we have a break. We have a study break during our Christmas time and New Year time. So this is what the dates are when we will break up for the study period. So I'll just bring up our study plan. There we go. So here's our study plan. This week, we will cover internal controls topic 1, then next week topic 2 on internal controls, and then we will break for Christmas and New Year's from 10th of December to 4th of January. We will be back on 7th of January. So please mark that in your calendars. This is what we are doing, and enjoy your Christmas and New Year's time during the break. So going back to what you have to cover in the assessments or what you will be assessed on in your assessments. So there are 9 questions and case studies as mentioned before. You will be assessed on the ability to interpret and comply with corporate governance requirements, and also implement effective operating procedures to ensure organizational compliance, use a range of methods, business, and routines that are relevant to internal control procedures, and monitor internal control operating procedures. So this is mainly in terms of performance evidence you will have to demonstrate in your assessment, and that's how your questions are devised. In knowledge evidence, you will be asked to explain ethical and confidentiality considerations when managing and handling files and business records, any financial legislation relating to financial transactions and reporting, benefits and limitations of internal control. Again, corporate governance policies and key requirements of corporate governance and financial delegations under organizational policies and procedures, and of course, key principles of internal control and auditing. So that's what your assessment questions are all based on. All information comes from training.gov.au. Moving on now, readings for this week. If you start from your learner guide, right at the start under topic 1, you have been asked to go and read this case study. The link to the case study, when I just before starting this session, when I was preparing my PowerPoints, what I noticed was Within the um, PDF format of Learner Guide, I wasn't able to access that link. So what I will do is I will provide these PowerPoints shortly, and you should be able to access this link through the PowerPoints in case they're not working in your PDF format as well. Then the next reading is Chapter 7, Internal Controls 1, and you have been provided with the PDF copy of that reading through Blackboard site. If any issues in accessing those, please let me know. So let's start with evolution of corporate governance. What is corporate governance? Now, when you are operating a business, and whether it's a small business, a big business, a public listed entity, whatever type of business you're operating, it is expected that you have some good controls in place that will avoid any fraudulent transaction to take place. For example, if you run or operate a small business, medium-sized business, then and you're dealing with cash, that means you're selling items over the counter. Say you are in retail and you accept cash in your business. What will happen is you might have staff employed in your business, and maybe you're not present at the cash counter all the time, and maybe um, your staff who's working at the counter taking cash, um, maybe is not recording or depositing all the cash in the bank, right? So what it means is your business is susceptible to theft. So your cash in the business is susceptible to theft. What it means is you do not have certain strict policies, procedures, or controls over your business that will avoid from that fraudulent transaction to take place. Hence, this is what corporate governance is about. It's the governance, it's the system by which the companies are directed and managed. Now, for small and medium-sized businesses, it's not a requirement to have strict corporate governance practices in the business. Why? Because of the nature and size of businesses. But when you are a big business, when I say big, I'm talking about public listed entities, right? Big public listed businesses. They are required to have very strict policies and procedures around the corporate governance of the business. So, and not only because they are it's for the good of the business. There's a requirement imposed by Australian Securities Exchange that you should have good corporate governance principles and some internal controls that will avoid from those fraudulent transactions to take place. When we look at corporate governance, the definition of it, one of the organizations, that is Organization for Economic and Cooperation Development Committee, it launched a review of its principles of corporate governance in 2014. Now, it was as a result of the global financial crisis, GFC, that you read up on the screen, stands for Global Financial Crisis. It was because of the partial response of the global financial crisis that revealed that poor corporate governance practices in the businesses are one of the major causes of why we have hit that financial crisis in the market. So then came a release by the Australian Securities and Exchange on corporate governance principles. So then, well, there were corporate governance principles that existed before, but then we went into much more strict corporate governance principle requirements that will help avoid any fraudulent transactions taking place and the businesses to run smoothly. Now, think of it when we are talking about businesses, public listed companies, we are talking about big banks, we are talking about uh, airline industry, we are talking about retail centers that are operating in the shopping centers. We are talking about a lot of businesses that we deal with in our day to day life. Not only that, we also have our investments there, whether we like it or not, but we have our investments in those businesses. You might be thinking, how? Think about when we work and when we are employed by an organization or when we are self employed, we are required to maintain a super fund, right? Maintain our super accounts, which is our retirement savings. If you go and check our retirement savings, where are they invested? They are mainly invested in these public listed companies, in the shares of these public listed companies. So when a global financial crisis hits, what happens? We lose our investments. When the share market crashes, our retirement savings also comes down. It gets affected very heavily. So that is why there is a requirement that people, public should not be losing faith in the financial markets. Hence, there is corporate governance principles that are imposed by the Securities Exchange, not only by Australian Security Exchange, but also by exchange committees all over the world, wherever the stock exchange exists. They are mainly on the same principles what you will see on the Australian Stock Exchange. So in other words, corporate governance is a dominant approach which has shareholder in the center, right? It is based on shareholders' investment. Should include interest of all stakeholders, including individuals, organizations, and society, but it is mainly shareholder centered. Entities listed on the Australian Securities Exchange are required to have a majority of independent directors. That's a requirement. Independent directors are the ones who do not have anything to do with the day to day operations of the business. Hence, they are independent of the operations of the business. And that's a requirement by the corporate governance. Public listed entities are required to have independent directors in the business. Also, internal control systems and accounting reports, they play an important role in monitoring the decisions and policies made as part of a corporate governance structure. So here's the definition of corporate governance. It's the system by which the companies are directed and managed. It's a system, right? Not a regulation, it's a system. It influences how the objectives of the company are set and achieved, how risk is monitored and assessed, and how performance is optimized. So that's what corporate governance is about. Now, here's a brief history of how corporate governance actually evolved or why there was a need for corporate governance. It goes back to 1980s, late 1980s. And what you see here are the names of those businesses, those very big entities, those which are not in existence anymore, or which have revealed big uh, um, frauds within the financial industry. So these businesses, if you go and search online, you will find about them. This one mainly, Enron. Enron. HIH was an Australian company. Then you must be aware of General Motors. ABC Learning was an Australian company. ABC Learning Centers. And you have an assessment question based on ABC Learning. So have a look at these corporate collapses. starting from 1980. And if you search online, just a quick search will come up with the corporate collapses, or search by their name, or just type corporate collapses. And you will come across with these businesses, how these businesses um, have led to uh, our shareholders losing interest and faith in the financial markets. Hence, there's a need for corporate governance in the businesses. So have a look what they are, will be interesting. Then in 2002, America came up with a Sarbanes-Oxley Act. Sarbanes-Oxley Act. This sets good corporate governance and ethical business practices. So it's mainly about how businesses should be incorporating good corporate governance and following ethical principles and practices so that the financial reports are not fraudulently prepared, or there's any misstatement carried in the financial reports. After the Sarbanes-Oxley Act, when it came into existence in 2002, Australian Securities Exchange came up with corporate governance principles. So back in 2003, 10 principles for listed companies. Then we continue to uh, evolve it and change it, amend it. Now we are in the third edition of its release, and it has these 8 corporate governance principles: lay solid foundation, structure the board, act ethically, responsibly, and a few others that you can read up on the screen. What I will suggest is you go online, although they have been provided to you in your reading for this week of chapter 7, all explained there. But if you are interested, is to go online onto um, Australian Stock Exchange website and then type corporate governance principles, or just type ASX corporate governance principles, and you come up with their explanation, um, what they are and they are into existence and what each of these principles are. So have a look, spend some time going over these, and if any questions, come back. Then we move on to IT governance. IT stands for Information Technology Governance. Now, in this age where businesses are heavily reliant on information technology, this becomes a subset, right? Information technology governance becomes a subset of corporate governance. It's about the accountability to shareholders and stakeholders, and they impact all functions and processes of the business, because we need computers to record transactions, those softwares. We convey information to our shareholders through information technology. We exchange, we exchange information through information technology. We also invest in shares and in the market through information technology. It plays a really important and big role. We do banking through information technology. Hence, it becomes very important that businesses have good corporate governance structure over the information technology of the business. Hence, IT investment is significant and increasingly becoming being included into organizations. For example, simple ones: websites, basic e-commerce, electronic communication systems. Advanced ones are enterprise resource planning systems. Chapter 7 of your textbook talks about it a little bit, although you're not required to work on this for the scope of your unit. But in case if you are interested, then have a look what enterprise resourcing planning systems are. So we look at the websites, we look at the e-commerce, and we do buy goods online these days, which is very common form of purchasing or shopping online. Hence, we need some IT structures and governance in place, because if there are not, then purchasing goods online will not be safe. Hence, it's important. IT governance is concerned with whether information technology is being used within the organization in the manner it is intended. For example, there are four main objectives. It's about ensuring consistency with the organizational goals, ensuring IT used to optimize business opportunities, and to ensure responsible usage, along with ensuring appropriate risk management strategies are in place in the business. The standard of IT governance implies that management should take responsibilities in these three key areas where there's an agenda setting for IT integration into overall business strategy. It is about ensuring an appropriate level of investment in the IT business capabilities. That means training your staff, you have the right softwares, you have proper um, uh, safeguards. Say, for example, you have uh, any spywares installed, your information is not hacked. Successful operational use of IT in routine business activities. So these are the three areas that the organization's management organization should be responsible and should be taking care of. For example, let me just talk about one of the examples. Recently, it was in news that Uber, right? Uber, uh, their client information was being hacked. So Uber's client information was being hacked. Now think of it. They have millions of customers worldwide, and their clients have stored their financial information with Uber, right? When Uber's client information is hacked, that means all those clients' financial information might have been attacked, might have been exposed. So that's something the business needs to put some structures and policies in place, that their IT is well managed, right? So these are the things you need to think upon when you're looking at IT governance and the responsibility of management in IT. Now, here are 5 key areas that need to be considered by those with the responsibility of managing IT. When I say those with the responsibility of managing IT, I'm talking about the management of the business. When it comes to public listed companies, it is the board of directors who are responsible for these. Their responsibilities are to add value, manage risk, match IT to the business strategy they have, measure the performance of the business through IT, or even measure the performance of how IT systems are operating, and they should be managing their resources. So these are the 5 areas that they need to consider. Then we move on to internal controls. Internal control. What are internal controls? It's the measures the organization or an organization employs to attain the objectives of efficient operations, reliable reporting, and compliance with relevant laws. They are very essential to an organization's corporate governance structure. There's an auditing standard, a very big auditing standard, but a very important auditing standard, ASA 315. If you search online, you will find this standard, ASA 315. What it talks about is, in terms of internal controls, that the management is responsible to take reasonable measures to make sure there are sufficient internal controls in a business, so that the reliability on the financial statements that are prepared by the businesses increases, and shareholders and other stakeholders are able to rely on the information that financial reports, when the financial reports are prepared. It also talks about the effectiveness and efficiency of the operations and compliance with laws and regulation. When I talk about compliance with laws and regulations, it's about um, corporations law, which are imposed on the companies, especially the public listed companies. Internal controls, there are quite a few definitions of internal controls. One of the organization called COSO defines internal control is, the definition here is deliberately broad and reflects the following fundamental concepts. So this is what COSO talks about internal control, that the definition is broad and reflects the following fundamental concepts. It is geared towards achieving objectives in one or more categories. That means it's geared towards the operations of the business, reporting and compliance with the laws. Reporting means financial reporting, providing information to the shareholders about the financials of the business, compliance with the relevant standards and corporations law. It also is about the process of ongoing tasks and activities. It's a means to an end, not an end in itself. So when those financial statements are prepared by the businesses, it's about not just only it's a 1 year thing. It's an ongoing thing, and businesses have to report to their shareholders over and over again, not just only at the end of the financial year. Financial markets are dependent on that. Hence, it's an ongoing process that the businesses maintain and keep a check on their internal control. Affected by people. This is not just about policies and procedures, but about people and their actions. Who are the people, those who are working on the internal controls of the business? These are the people who are recording transactions in the business. Now, let me give you an example. Say, for instance, you are working in an organization. Say you're working as an accounts payable officer, and you have been asked to record um, an invoice of $10,000 for the purchase of, say, electronics. Will you go and record that invoice in the system and make a payment just by itself? Probably not. Why? Because it's about internal controls. How? You will need the authorization by a manager, by a relevant manager, in recording to record that invoice in the systems. Because as an employee, if another employee gives you an invoice, probably you haven't received the goods. Probably the employee is just asking you to record a transaction which could be fake. Hence, you will need to check, first of all, whether the goods were received or not. Second, you will need to have an authorization by some manager within your firm, within your organization, that confirms, yes, payment approved or invoice approved for payment. Hence, it shows there are internal controls in the business, and this will avoid from recording any fraudulent transactions or even any misstatements of assets. Then internal control concept is also about providing reasonable assurance to the board and management. Now, this is this is an auditing concept, and you shouldn't be worried too much about it. Reasonable assurance is the level of assurance that the auditors provide to the shareholders on the truth and fairness of the financial statements. Not absolute. Absolute means guarantee. Reasonable assurance is the highest level of assurance that the auditors provide to the shareholders. Hence, when there are internal controls in the business, auditors can rely and shareholders can rely that company has put some good internal controls and has some good corporate governance policies that will help avoid any fraudulent transactions taking place in the business. And the organization, it's adaptable to the organization's structure for the whole organization as a subsidiary or a division or a business process. So internal controls should be adaptable because every business is different. Hence, you would like to see the internal controls are adaptable as per the business's structure and requirements. So you will see that they are flexible and they are well suited to the business environment. Here is one of the definitions of internal control prepared by Australian Standard on Assurance Engagement. This definition was released in January 2015, the most recent one. It defines it as the process designed, implemented, and maintained by those charged with governance. Now, those charged with governance means the board of directors of the business, management, and other personnel to mitigate the risks which may prevent achievement of control objectives relating to entities' system. Controls included in the scope of the assurance engagement may comprise any aspects of one or more components of control over the areas of activity within the defined boundaries, such as group, entity, facility, or location. Very complex definition. You don't have to worry too much about it. It comes mainly from the perspective of audit profession. Hence, it talks about the scope of assurance engagement. Assurance engagement means an audit engagement. Hence, this definition comes by the Australian standards for audit engagements on controls. Don't have to memorize this. It's just there explaining what it is. COSO framework, which is an organization, and it developed a framework regarding the control objectives, outlines 3 control objectives. First is about the operation objectives. It's about the effectiveness and efficiency of the business operations. When you're recording transactions, when you're operating a business, it's about it should flow smoothly. It should not be interrupting in the business process. It should be embedded in your business process. So the businesses should have some policies and procedures set that will help achieve those objectives. Reporting objectives, it's about the internal and external financial and non-financial obligations of an organization. So it should be about financial statements, right, that the business prepares. It should be helpful in achieving the financial objectives of the business, and the financial statements that are prepared should be prepared on the basis of truth and fairness, so that they are not misleading to the shareholders. And the third one is compliance objectives that relates to its adherence to laws and regulations to which the organization is subject to. For example, it could be Corporations Act, it could be AASB standards, it could be Australian Security Exchange requirements, it could be ASIC, Australian Securities and Investment requirement for the registration of the business. It could be anything, any of the regulation that surrounds a business. So internal control framework depends on these 3 objectives. Then there are 5 components of internal control framework. First one is the control environment, risk assessment, control activities, information and communication, and monitoring. Now, your textbook talks about these in detail, and you have an assessment question on this. So I will suggest you spend some time understanding these, what they are. And then if you have questions, I'm happy to discuss. Further, identifying risks It's useful technique for the businesses to identify risks that will help prepare the financial statements in a true and fair manner. Financial statements contain a set of assertions made by the preparer, that is the management and board of directors of the business. So it contains a set of assertions for reporting period and the financial position at the end of the reporting period. Also, when you're identifying risks, it's about the policies, procedures, and internal controls that are put in place towards achieving those assertions satisfactorily. I'll talk about those assertions shortly, what those assertions are. Have a look. This is a copy of the table from chapter 7 of your textbook. This is, on this side, you see the occurrence. These occurrences are classified into different, these occurrences are classified for balance sheet accounts, for profit and loss accounts, and also about disclosures in the financial statements. You don't have to worry about them. But what you have to understand here is board of directors of the business, they make these assertions, right? Assertions called occurrence, completeness, accuracy, cutoff, and classification, existence, rights and obligations, completeness, and valuation. If I go back a slide, occurrence means what they are saying, the business managers are saying, all transactions included in the financial statements have occurred. That means they have taken place. The risk to such an assertion can be maybe the transactions did not take place, they did not occur. Example of this risk is sales entered have not actually taken place. So when you're preparing those financial statements, the sales recorded in those financial statements did not take place. So it shows there's a risk. Hence, what you would expect to see, business put in some process or policy in place. Process could be to verify that the transactions have taken place before being recorded. So you should not be recording transactions, right, if they haven't taken place. Some sort of policy or procedure should be there in the business that will ensure that only transactions that have taken place have been recorded. For example, you are working in the purchases side of the business, right? Let's take the example of purchases. You are working in the purchases side of business, and you have been asked to buy some assets for the business. To buy some assets, or even say stock, right? Stock for the business. To make sure that the transaction actually has taken place, to be recorded into the financial statements of the business, you would want a purchase order to be raised, right? Purchase order. That will be the evidence that you have requested some goods from your supplier. That's an evidence that you have ordered some goods received, and then you record them, right? That's just one example. Moving on then, next assertion is completeness. So the management of the business asserts that all transactions and events that should have been recorded have been recorded. Now, this becomes a big problem for the businesses. Say, for example, we have a business who operates in uh, electronic goods, JB Hi-Fi, right? Say, for instance, there is economic downturn, and now what happens is people are not buying as much electronic goods what they were buying during good economic times. So the business will be under the pressure to record some fraudulent transactions or to increase their sales, right? In that instance, you are looking for um, uh, or maybe the business has too much expenses. Let's talk about expenses, right? Expenses. Business has too much expenses And when you record expenses in the financial statements, it reduces your net profit, right? When you record too many expenses in your profit and loss, it leads to decrease in your um, net profit. What that means is, in relation to this completeness, sometimes you will be under the pressure to record less expenses so that you show bigger profits to your shareholders. Hence, the assertion here, risk with this assertion is transactions may have been omitted. You have not recorded those expenses in those profit and loss statements. Example of another risk is sales occurring but not recorded. So process to check for missing transactions on events should be a control measure put in place by the business. So I will suggest spend time on reading through what these assertions are made by the management, and then what could be the risks related to those assertions. All explained there in your textbook, but also if you have questions, then come back and you have an assessment question on that risks and assertions. More examples there from your textbook. When you're identifying risks from assertions listed in the table, the potential threats that you need to analyze the items in the financial statements could be existence, occurrence, valuation, completeness. All there in the table. Existence, that incorrectly recording of an equity item exists in your balance sheet. Occurrence, you incorrectly recording revenue or an expense item occurs in your financial statement. Valuation and measurement, what are your recording measures? For example, when you've purchased an asset, have you recorded it as an asset or not, right? Or have you recorded it as an expense? What is the measurement that you're using? Which chart of accounts do they go into? Completeness, partially recorded some transactions. Those could be the risks. There are other risks also that need to be considered. All explained in that table. Have a look. 2 points to take from the auditing position if you are looking and checking the financials of a business are: first, the auditing standards focus on risk from a financial perspective, and the concept of risk is broad and can include risks that come from poor quality control or inefficient or ineffective operations. Moving on then, the key components of internal control is about making reasonable assurance that organization meets its objectives, financial objectives and goals. It's about management, that different people are involved in internal controls and people affect how internal controls operate within the business. When I say different people are involved in internal controls, say for example, you are working in an organization, a big public listed company, and you are using a big accounting software system, not just only an accounting system, maybe say it's an enterprise resource management system. And an example of that could be SAP, SAP. SAP is a very known and big software which is used by big businesses, very popular one. What you do is, uh, say you're working in accounts receivable, the entity should put some internal controls in place that you only have access to accounts receivable side of it and not towards the payable side of the business. So it puts some internal controls. Different people within the organization and bigger businesses will be involved in different functions. So there will be payables department who will be dealing with the payments and recording of purchases. Accounts receivable department will be dealing with recording transactions related to sales and payments received from your customers. Hence, you'd like to see that in place put by the management in an organization. Control objectives will be about the effectiveness of the operations, which is profitable operations, and protecting the resources of the business. Reliability of financial reporting will also be a control objective. It is about compliance with applicable laws and regulation and legislative requirements. Then internal control system is made up of these internal control objectives that I showed you before. So here they are explained. You have an assessment question on this. It's based on control environment, which is about the attitude and awareness of the management and staff of the business. How do they treat the control environment of the business? Do they let you record transactions without approval? Then it shows the management attitude is not right. What is management's philosophy, overall commitment, and attitude to ethics and integrity for that influences the behavior? That means, is the management taking decisions which make sure that ethics have been taken care of, and there's no conflict of interest when you're recording transactions, there's no fraudulent transactions recorded. Then moving on to risk assessment is about awareness of possible threats. Threats, for example, what could be the threats that could exist within your recording of financial statements or transactions? You should be aware of those risks and should be putting some control measures in place. What the control activities of the business is, that is management's responses to the identified risks. If they have identified risks, then what type of control measures does management put in place? Those are called control activities. Then information and communication is about essential elements for satisfactory function of the business activities, and also encompasses the design of the information system. How is the information system of the business designed and how is it operated? And the last one is about monitoring, which is continued monitoring required of any system if it is to remain effective and needs to occur on regular basis. Also, can be performed by both internal and external parties. Monitoring of the business and senior management plays a critical role in this. Now that brings us to the end of what we needed to cover from this topic. With the completion of this topic, you should be able to work on these assessment questions. Now, what I will do is I will go over these assessment questions next week before we start topic 2, right? Before we start topic 2 on internal controls 2. In the meantime, what I will suggest is go over the readings and work through these activities 1.1 to 1.3 in your learner guide. And then next week, before starting our topic 2, I will go over these assessment questions and we'll see how we can address them. Is that okay, Ayami? Okay, thank you for confirming. So have a read and bring your questions. Try and attempt these questions, and then I'll bring over some guidance next week on these assessment questions. Well, on that note, let's finish the session by asking if you have any questions or something you'd like to contribute, Ayami.